Okay, we have now made it through the Consumer Price Index report covering the month of November and came through with flying colors. The report came out actually nailing the expectations that you and I talked about yesterday, beating the expectations from most of the economists and what they were putting out and what was out on the street, as they call it. And home loan interest rates really loving that number, getting ready for the next event that we need to get through, and we've been talking about, which is the Federal Reserve making their adjustments to the federal funds rate. Now, we're going to talk at the end here in just a minute about what you need to know about the federal funds rate being adjusted and what you need to communicate to anybody that you are speaking with. Okay, so first of all, let's jump over here. Again, today is now December the 13th, 2022. It is 2:37 p.m. Central Time. So here is a report on the Consumer Price Index. No, not this report here. Here it is saying the Consumer Price Index rose by just 0.1% from the previous month. Now, that is the headline number. The number that we are going to be looking at is the core CPI. Again, the core CPI, Consumer Price Index, is stripping out food and energy. Okay, so it takes this basket of goods, removes food and energy, and gives us the core number. Now, we had said that yesterday, most people were anticipating this core number to come in at 0.3% month over month inflation. So basically, think about that. If you look at a can of corn that is in your grocery basket, they're saying that that can of corn cost 0.3% more than it did in October. So the November reading versus the October reading. Now, we said that it would come in at 0.2%, and that is exactly where it came in. It came in at 0.2% on the core reading versus 0.3%, which allows the annual year-over-year reading to be 6% instead of 6.1%. Now, hang in there because I'm going to make sure to talk to you about some of the psychology of what this means, which is what we're also learning about here. So let's jump over to this other chart. These charts, again, I always want to give a shout out to the people at MBS Highway, which is where I get these charts from. There's their logo right there. Appreciate Barry Habib, Dan Habib, and all of those that work at MBS Highway. So this is what you need to understand in order for you to project what's going to happen next year. So if you are in the housing industry and you're saying, when is this freeze of the home loan industry and housing industry going to thaw? Well, this is why I think what I think and how I make my predictions, or projections, I should say, not predictions. Okay, so here we go. Today, the core CPI came in at 0.2% for the month of November 2022. The annual reading is basically taking each of these monthly readings and adding them together. The aggregate of the last 12 months is what makes it up the year-over-year inflation reading. So being that we were able to kick out November of 2022, which is right here, which was a reading of 0.5, and replace this with a reading of 0.2, that allows our year-over-year number to go down by 0.3%, which is exactly what happened. It was at 6.3 until this report came out. Now it is at 6.0, which is why they can say that inflation is subsiding, because year over year, the inflation rate is subsiding, going down. Now, here's what you need to understand and why I'm so optimistic for 2023. What do we need to replace next month? So on our next CPI reading comes out, we need to replace a 0.6. In January, a 0.6. In February, a 0.5. So for the next 3 months, we have rather high readings that we need to replace, which will be fairly easy, being that, do you think that housing has subsided? Okay, so not that housing has gotten cheaper, but that housing isn't going up as fast as it was. Do you think that energy has slowed down? Is gasoline cheaper now than it was a month ago? Absolutely. Are other products not reducing in price, but not rocketing up like they were? A piece of plywood, a 2x4, groceries, not that they're getting cheaper, but they're not going up like they were. That's what we need. If you believe that is the case, then you can also believe that we're going to get lower numbers than 0.6, 0.6, and 0.5 for the next 3 months on our core CPI. If that is the case, then our annual year-over-year reading also will go down as the aggregate of these 12 numbers is reduced. If that makes sense to you, you have now seen the future, and you can tell that the overall inflation is going to go down over the next 3 months at least. We may have a moment where we have a little bit of a bump because 0.3 is a rather low number in March. If we get a 0.4, then the news is going to say, oh, inflation's back. It's not back, because then the next 3 months, 0.6, 0.6, 0.7, very high numbers. We are definitely going to see a 6, 7, maybe 8-month run of inflation going down pretty dramatically when you really look at the grand scheme of things. That's going to allow home loan interest rates to go down as well. That is what is going to happen in the future. Unless you suddenly see the cost of goods around you going up, not staying the same, but going up dramatically, then you can be very optimistic that not only are home loan interest rates going to go down, but that housing is going to start to move again and homes are going to sell, because we are going to see home loan interest rates drop into the mid fives. And again, my projection, prediction, crystal ball, whatever you want to call it, is that we are going to be offering a 4.875% 0.30-year fixed conventional loan in the first half of 2023. That is what I am banking on, betting on, and expecting to happen based on the numbers that I just showed you, along with other reports that we talk about here on the Brent Bruce Daily regularly. So where are we right now on our home loan interest rates? Let's get into that. We got to go over to here. All right. So right now we are up 50 basis points, which is great. We were up 90 at one point. We were up 90, bounced back down a little bit. Why did we bounce back down? Because we hit this ceiling of resistance at the Fibonacci level at 101,688 and bounced back down. Now we're fighting here, staying just above the 100-day moving average. That was acting as a ceiling yesterday and even the day before, but now we are above that, waiting for what? What are we waiting for at this point? What are we waiting for to come out? The news from the Federal Reserve. We want to make sure that they give us a reading of a 0.5% increase to the federal funds rate, and that they don't make any crazy comments saying we think that inflation is still running rampant and we need to go after it with higher increases or longer increases. Hopefully they're going to say, look, it seems to be that inflation is showing signs of relaxing, of subsiding a little bit. And then home loan interest rates are going to love it. Okay. So where are we in the 10-year treasury? We are down 10 basis points. Also great news. Where are we on the Brent Bruce Daily home loan interest rates, which is the big question that you're all waiting around for, I imagine. All right. So we are on our scenario, Brent Bruce Daily. Let's go in here. 30-year fixed conventional. We are sitting at 6.125. All right. Why are we not sitting at 5.99? Well, let's open this up a little bit. 5.99 because it costs $68 to get there. Okay. $68, which basically means anybody is going to offer a 5.999%. The Brent Bruce Daily Rancho Capital Home Loans, we are going to offer 5.999 to a well-qualified 30-year fixed conventional client and charge them $68 in discount points. Here is the parameters of that transaction. Very well qualified 30-year fixed conventional home loan. All right. So for a point or just under about a half a point, you're at 5.875. All right. So overall, we're basically back at that 5.999 on our 30-year fix. What you need to know about tomorrow is that when the Federal Reserve increases the federal funds rate, again, I wish we were all in class here so we could say it out loud together, that does not increase home loan interest rates. The federal funds rate does not increase home loan interest rates. The federal funds rate directly affects the prime rate. The prime rate then directly affects things like home equity lines of credit, credit cards, and some auto loans and some adjustable rate loans as well, but not 30-year fixed conventional loans. We will probably see the 30-year fixed conventional loan go down further into the fives, maybe a 5.875 or a 5.75 30-year fix with no points at all if the Federal Reserve brings out the federal funds rate being increased by 0.5%, but then makes comments that they do see inflation subsiding. That is what we need to hear, are comments that confirm what we've been talking about here on the Brent Bruce Daily for months. That is what is going on. Let's see how things go tomorrow. The saga continues, but I want to make sure that you are reading between the lines and right on the front page of the Brent Bruce Daily that 2023 is looking to be a much better year as home loan interest rates come down, not because I just want them to, because we have data and we can see what's going on in the market. Let me know your questions, thoughts, concerns. Make sure that you like and subscribe and share, and I will talk to you again tomorrow.